Welcome to this comprehensive guide on day trading, where we embark on an exploration of the exhilarating world of intraday trading. In this enlightening journey, we will uncover the strategies, delve into the inherent risks, and unveil the potential rewards of this dynamic financial pursuit. What is day trading? At its core, day trading, also known as intraday trading, is a trading strategy characterized by the swift execution of trades in financial markets. The primary objective? To harness the power of short-term price fluctuations and capitalize on them within the confines of a single trading day. Key characteristics. Day traders, the stalwarts of this endeavor, rely heavily on the fine art of technical analysis, closely examining price charts, identifying patterns, and analyzing indicators to make rapid-fire decisions. It's a realm where every moment counts, and agility is paramount. A defining feature of day trading is the practice of not holding positions overnight. This cautious approach helps traders evade the risks associated with overnight price gaps and the added margin requirements that come with it. Moreover, it ensures that each day begins with a clean slate. In the world of day trading, concepts like high-frequency trading, leverage, and risk management take center stage. High-frequency trading entails executing a high number of trades in a single day, often with the aim of accruing small, frequent profits. Leverage, on the other hand, magnifies both gains and losses, making risk management a cornerstone of day trading. It involves safeguarding capital through prudent practices like setting stop-loss orders and managing position sizes. Markets for day trading. While stocks are often synonymous with day trading, this pursuit extends its reach to other financial markets. Traders explore the realms of forex, futures, options, and even the cryptocurrency domain in their quest for intraday opportunities. Risk and reward. The allure of day trading lies in the potential for rapid profit accumulation. Yet, it's essential to acknowledge that this path is not without its share of risks. In the whirlwind of intraday trading, substantial financial losses are also a possibility. The crux of navigating this treacherous terrain successfully lies in the realm of risk management. This critical facet encompasses a range of protective measures, including the strategic placement of stop-loss orders, judicious portfolio diversification, and the meticulous sizing of positions to align with risk tolerance. Technical analysis. Technical analysis, often considered the lifeblood of day trading, is a practice that involves deciphering price charts, patterns, and indicators to identify opportune entry and exit points. Candlestick patterns, moving averages, relative strength indicators, and Fibonacci retracement levels are but a few of the tools at the disposal of day traders. Day trading strategies. Day traders are equipped with a repertoire of strategies, each tailored to specific market conditions and trader preferences. Scalping, characterized by a high volume of swift, small trades, aims to profit from minute price fluctuations. Momentum trading, on the other hand, entails capitalizing on existing trends, while contrarian trading ventures against the prevailing market sentiment, seeking opportunities in potential reversals. Tools for day trading. To navigate the intricacies of day trading effectively, traders need access to robust trading platforms. These platforms should provide real-time data feeds, seamless order execution capabilities, and an array of essential tools to aid in decision-making. Within this toolset, you'll find Level 2 quotes, which offer deeper insights into market depth, direct market access, DMA, for lightning-fast order execution, and advanced charting software that empowers traders to visualize market movements with precision. Psychology of day trading. The psychology of trading casts a formidable shadow over day traders. Emotions like fear and greed can exert substantial influence over trading decisions, often leading to impulsive actions. Hence, successful day traders embark on a quest to cultivate emotional discipline, mental resilience, and an unwavering focus to keep emotions in check during the intensity of trading. Risk management. Effective risk management stands as the guardian of capital. It involves the strategic implementation of protective measures to mitigate potential losses. Setting stop-loss orders at predefined price levels to limit downside risk, determining position sizes based on account size and risk tolerance, and diversifying trades across different instruments are fundamental elements of a well-structured risk management plan. Capital requirements. Day trading comes with a distinct financial prerequisite: the need for substantial capital. This requirement arises due to the use of leverage and the demand for margin accounts, both of which facilitate frequent, large-volume trades. Aspiring day traders must be prepared to meet these financial prerequisites to engage in this dynamic arena. Regulations. The world of day trading operates within a framework of regulations, and traders must navigate these rules diligently. In the United States, for instance, pattern day trading rules dictate minimum account balances and trading restrictions for those classified as pattern day traders. Continuous learning. Successful day traders are, at their core, lifelong learners. Markets evolve, strategies adapt, and knowledge expands. To remain competitive in the ever-shifting landscape of day trading, one must commit to continuous education, stay informed about market news, and consistently refine trading strategies. Conclusion. In closing, day trading represents a captivating avenue toward financial independence, where potential rewards and risks coexist. It is a realm where opportunity and peril walk hand in hand.